it's not so obvious for a non-US investor to buy a US municipal bond. US municipal bonds are issued by states and local governments across the United States, and they're issued in order to raise money for that state or local government to fund projects, namely things like the hospitals, roads in the state. It also is used to fund pension scheme benefits for the state employees. So the state has a choice. It can either increase taxes to fund these projects, or it can try and raise money. Increasing taxes is not a popularist move, and so over the years, US states and local governments have raised money through issuing bonds. And there are about 3,000 issuers across the United States, so plenty of choice for the US investor. And the real tax advantage for them is tax exempt interest on these bonds. So that makes those bonds look really competitive compared to other issuances from corporates, such as companies like Apple or Exxon. So the US investors pile in, but non-US investors have no such tax advantages, so they don't tend to buy them. Except European banks are the exception. European banks have piled into these bonds because of a loophole in global capital rules for the banks that means they can categorise those bonds as US government debt. It's not strictly true, of course, but this loophole has allowed these European banks to earn a higher yield on those assets whilst declaring them on their balance sheet as sovereign debt. Of course, Detroit's now gone bankrupt. Things aren't so happy for these European banks. It's Dexia and Commerzbank who are shown to have the most exposure, and it's the next crisis since those banks owned Greek government debt. Courtiers has no exposure to direct municipal bonds in the US and no exposure to Dexia and Commerzbank.